Are you someone who is investing into SIPs and mutual funds so that you can grow your wealth for the long term? Then I would tell you to stop your SIP investments. But no, I do not mean to stop your investments forever. There are certain mistakes that retail investors do while investing into SIPs that need to be stopped. Often banks and brokers take advantage of these mistakes by you, and they end up making or taking away a lot of your profits over the long term. That means if without making any mistakes you are supposed to make this much profits over the long term, you would end up only making this much profits. So in this video, we'll talk about 5 mistakes that you are doing which is limiting your profits from your SIP investment. So without further ado, let's get started. This is Ajay Ajith. Welcome to Market Feed. So these 5 mistakes I'll explain to you in a very proper order. So first we'll start with very small mistakes that a lot of people are doing, but it is very easy to fix. Then we'll move ahead and move into harder mistakes that might take some more time for you to fix all of that. So that's the order we are going to go with. So the first mistake that I've seen a lot of people making is not knowing whether they're investing into regular or direct mutual funds. So to explain that, let's go ahead into the screen here. So yes, in order to explain this, let's check out Axis Mutual Fund's website where they're showing a very particular fund, Axis Growth Opportunities Fund, right? So when you're going ahead, you can see that you're having an NAV of 31 rupees here. Your CAGR is 22.87%. The AUM is 13,000 crores. But what happens if I go ahead, click this button here and change it to direct? Notice what happens to the CAGR returns here. It went directly up to 24.62%. So you can see here, it is the exact same fund, Axis Growth Opportunities Fund, with the same fund manager, the same AUM, and the stocks they invest into are also the same. But the direct fund has a higher CAGR and the regular fund has a lower CAGR. So let us look at how much this different CAGR affects your returns by going into an SIP calculator. So I'm going into Google and searching for MarketFeed's SIP calculator. You can see it right here. Plan your investments with an SIP calculator. So let's go ahead and compare both of these mutual funds with a 10,000 rupees monthly SIP and with a 22.5 or 22.8% returns annually over a 20-year time period. Let us see how much returns that you're making. You'll be making 4.63 crores by investing 24 lakh rupees. Again, this is something which might not be possible, but just to show you how the different CAGRs affect your performance, we'll be talking about this, right? So over a 20-year period with the same investment, you'll be making 4.63 crore rupees. But now you might be thinking, how much difference will 1.5%, 2% make with your investments? Let's go ahead and check out how much returns you could have made or you would theoretically make with a direct mutual fund, right? So let's go ahead and change this into a direct mutual fund's returns, and you can see here immediately 6.33 crores is what you'll be making. So what do you understand here? If you had invested into a regular fund, you would have made 4.66 crore rupees, but if you had invested into a direct mutual fund, you would end up making more than 6 crore rupees, a 2 crore rupees difference over 20 years. So remember, in both of these cases, you're investing into the same mutual fund. Then the question is, who is taking away your 2 crore rupees in profits? Let's go ahead and check that. So in order to understand that, first let's compare a direct mutual fund and a regular mutual fund. So in the case of a direct mutual fund, as the name suggests, you'll be directly giving money to a mutual fund house. They'll be investing into multiple stocks and assets. They'll be making profits and they'll be sharing majority of that profits with you. They'll only be taking very few or very small charges like expense ratio, if you're cancelling early, exit load and all of that, right? But that will happen anyway. But if you're investing into a regular mutual fund, there'll be you, there'll be the mutual fund house, but in between both of you, there'll also be an agent who sits there and takes a commission of 1 to 1.5% or maybe even slightly higher or lower depending on the mutual fund scheme every year. No matter what profits that you make, every year they'll be taking this commission, and over the long term, this will end up costing you crores of rupees. So the question is, how do you differentiate between a direct and a regular mutual fund? So it is very easy. Whenever you're going to invest, as we saw in the Axis mutual fund website, there will be a very straightforward option for you there. You can see both the options. You can go ahead and select the direct option there. But also in the case of someone calling you, maybe it's from your bank, maybe it's from some other investment platform, and they're calling you and they're asking you to invest, most probably it'll be a regular mutual fund. Does that mean that regular funds is useless? No, I would say not. If you want someone who you can talk to, you can ask doubts to, who can rebalance your portfolio, tell you where to invest, then you should be thinking about investing into a regular mutual fund. Yes, obviously, you'll have to end up paying a commission for that. But if you're someone who is active in this community and you want to learn and then invest, then I would say direct mutual fund is a way to go for you. Now, you've understood the difference between a direct and a regular mutual fund. If you're investing into a regular fund, make sure you stop it today and move it to a direct mutual fund. Your fresh SIPs can be easily stopped and you can start a new direct mutual fund investment there. But if you have already invested a large corpus and they're all sitting in regular funds, the only option that you'll have is to take a temporary hit and to book those profits and to reinvest them into direct mutual funds. So yes, there will be a small tax implication there, but it will be worth it in the long term. The second mistake that I've seen people make is not understanding whether they're investing into a growth or an IDCW mutual fund. So anyway, in a mutual fund, they're investing into multiple stocks, and if you want to get the dividend, whatever they're making into your account, then you can go ahead and select the IDCW plan. But if you want them to reinvest this money and for your money to compound in the same mutual fund, then you should always select the growth plan. So I've seen a lot of people who are doing SIPs for the long term. They want to get the compounding benefits, but they end up taking the IDCW option so that they can get some regular withdrawals. But that is not the way to go. Your mind should be fully focused on the long term benefits, on the compounding benefits, and never on the withdrawal benefits, right? So you should always go ahead and select the growth plan. Here I'll show you the same mutual fund, HDFC FlexiCap Mutual Fund, which is making nearly 12% CAGR with the IDCW option, but the same fund with the growth option is making more than 23% CAGR. The taxation rules will also be a bit shaky because in IDCW, it might be taxed as short-term capital gains. And as you know, in the recent budget, the short-term capital gains has increased by quite a lot. And you always want to only withdraw with your long-term capital gains option. So make sure you're always using the growth option. And if you want to withdraw money, then you should be using an SWP option, never the IDCW, right? I've done a detailed video on SWP. I'll link it here in the I button. The third mistake that I've seen people making is investing only into small cap mutual funds. So over the last multiple years, the small cap index has given a phenomenal rally, and just by looking at the CAGR returns, people are judging that mutual fund and they're investing their hard-earned money, their entire money into small cap mutual funds. But that is never a good option. What are people thinking here? Mutual fund investment is generally considered safe. They're okay to start investments and SIPs, and they see that small cap funds have very high CAGR rates. So they're investing all their money into small cap mutual funds. But what people don't think about is diversification. So in this case, small caps have been performing really well, but it does not mean that they'll continue to perform well and outperform the market forever. In fact, during tough times in the market, small caps perform or underperform the market by quite a lot. And in those times, your investments might be in trouble. So you should always think about diversifying into multiple asset classes, or at least into multiple asset classes like gold, debt, equity, and also into inside equity. You can also think about large cap, mid cap, small cap, or even think about flexi cap mutual funds. In fact, we'll do a detailed video on flexi cap mutual funds. Make sure you're subscribed so you can watch that video. If you're doing SIPs for the long term, make sure you do not concentrate all your money into any mutual fund. Let it be small cap, large cap. Make sure you diversify it. I'll give you a very simple example here. So gold often rises up in value whenever the market crashes. So if you're an investor who has invested both into gold and equity and the market crashes, the gold prices go up, you can sell that gold investment and you can think about reinvesting it back into the market. And when the market moves back up, you can think about selling off that profits that you have made in equity and investing back into gold. That is one simple explanation of how diversification can help you increase your returns over the long term. One more thing that you have to remember here, even when you're doing this diversification and investing into multiple mutual funds, they might often end up investing into the same stocks. So in order to understand that, you can open any mutual fund summary here in Coin or any of your mutual fund platforms. You can scroll down and you can see where they're investing, right? And you can also check out the fund manager's philosophy and their psychology when they're investing into the market. So you can see here in the case of Quant Flexi Cap Fund, Reliance Industries Industries is having a 10.67% allocation, HDFC Bank is having 10.44% allocation, and there are other stocks as well. So if you find another mutual fund with the exact same allocation, then there is no point in calling it diversification. So make sure you think about this fact as well. Now we have understood the importance of diversification. So make sure you stop your SIP investments only into small cap funds and think about splitting it into multiple asset classes. Now let's move ahead into the last two mistakes. And as I've said in the beginning of the video, these are the most hard or difficult mistakes to fix. But the irony here is that a lot of people already know about it and they're consciously making this mistake without having any fear at all. So let's go ahead into the fourth mistake that people are making, which is not investing or not having an emergency fund before you start investing. When I'm trying to understand this concept, I've spoken to a lot of people and they always end up saying that I do not have an emergency fund, but I'm doing my SIP investments for the long term. But what people don't think about is that if they have an emergency fund, what is the importance there? Tomorrow, a situation might come in your life where you do not have an income for a considerable amount of time. Maybe you have to sustain on this emergency fund. And at that time, you would have to go ahead and sell your SIP investments and all your holdings at that time. But as you know, that is not ideal. You should let the magic of compounding work so that you can end up making more money over the long term. You would have started that SIP with a lot of goals, either your retirement, maybe a certain goal of buying a house, maybe a goal of buying a car even. And all those goals you're keeping aside just because you do not have an emergency fund. If you're making this mistake, if you're investing into SIPs before creating an emergency fund, make sure you go ahead and do that. Keep it very liquid in a bank or a debt mutual fund so that you can end up making some money, some returns over the long term, but never ever think about investing directly into SIPs for your long-term goals before thinking about your emergency funds. The fifth and the largest mistake here is that people directly invest into SIPs without having a term or even a health insurance. So I've talked to a lot of people and understood that they're very happy doing their SIP investments for the long term, but they've not even thought about having a health insurance or even a term insurance in place. But do you think that is right? I know most of you understand even that it is not right, but still end up doing that. I want to make you understand how much important this is. So let's go ahead directly look at the numbers so that you can understand its importance here. So when you're taking an SIP calculator and you're planning your same 10,000 rupees investment, monthly investment for 20 years over 24% because you are intelligently investing into a growth direct mutual fund here, right? And you might end up making 6.33 crores at this returns. Again, this is a very high returns. Do not plan for this, but just giving the same example here. So let's take a case here. You're happily investing for 5 years with this exact amount and you're getting or seeing a target of 6.33 crores over 20 years, right? But what is going to happen? Unfortunately, after 5 years, you meet with an accident or a hospital emergency and you need a sum of money. And when you go ahead and think about dipping into your savings or dipping into your investments, let's look at how much it would have become. So it would only become 11.8 lakh rupees. Right? So if you're someone who is capable of investing this much, maybe this amount might not even be significant for you after 5 years. And it is also stopping you from reaching your 6.3 crore rupees goal after 20 years. So make sure you think about that. Now here is where the importance of a health insurance comes. Now while doing your SIPs, imagine if you're having a health insurance or cover of maybe 10 lakh rupees for you and your family. What is going to happen here? After that 5 years period, when you have a hospital emergency, you can go ahead directly use your insurance amount here. You do not have to look into or deplete your savings at all. So this insurance premium that you will be paying, you have to see it as protection. You have to see it as a safety net with which you can avoid dipping into your savings or your long-term SIP goals at all, right? So that is a goal here. So I know a lot of you might ask this question, hey, I only have 10,000 rupees to invest or I only have X thousand rupees to invest. How will I at that time think about even investing or buying a health insurance there, right? The only answer there is you have to cut down your SIP investments and you have to start a health insurance plan. So let's take the same case here. If you are investing 10,000 rupees into your SIPs and you're currently you have split that amount into two. 2,000 rupees is going to your health insurance premiums and only 8,000 rupees is going to your SIPs. You would end up making only 5.07 crores, right? 1.5 crores or something lesser than what your goal was. But that is to be expected. That is a price that you're paying for your safety net that you will be having for the long term, right? And let's look at what if you had that emergency after 5 years and you ended up not investing into a health insurance, and that 2000 rupees extra that you are supposed to buy insurance with, how much money would you have at the end of 5 years, right? You would only have 2.36 lakhs. This might not even cover your hospital bills at that time. So here we understand the importance of having a proper health insurance. At the same 2000 rupees premium that you're paying, you might end up with a cover of 10 lakh rupees or even higher for you and your entire family. So that is going to be very, very important. It might take you longer to reach your goals by doing all of this, but emergency funds and insurance are very important factors in order to sustainably make and ensure your wealth for the long term. So make sure you go ahead and think of that. And in order to understand how much exactly to invest into mutual funds, how much to put into health insurance and term insurance premiums, please contact a financial planner, right? That is also super, super important. So if you're a mutual fund SIP investor, make sure you go ahead and continue your investments only after fixing these 5 very important mistakes. So yes, that's it for this video. Make sure you get subscribed if you want the most practical finance and stock market content in India. This is Ajay Ajith signing off. See you all again. Bye bye.